Real estate is imploding, down 3.7% this week, with a deeply oversold RSI of 24. As interest rates spark a bearish trend, this is what every serious investor needs to know about real estate right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, the overall market context is characterized by elevated uncertainty, with the VIX at 26.8, indicating a higher level of risk aversion among investors. In this environment, the real estate sector is particularly noteworthy, as it has underperformed the S&P 500 this week. The sector ETF, VNQ, has posted a decline of approximately 3.7%, which is a significant move. Given its current trajectory, the real estate sector deserves attention, as it can often be a leading indicator of broader economic trends. As a key component of the economy, the real estate sector's performance can have far-reaching implications for investors, making it essential to closely monitor its developments. This sector is sensitive to changes in interest rates, economic growth, and consumer behavior, so understanding its dynamics is crucial for informed investment decisions. Let us start with the technical picture and what the charts are telling us. The real estate sector, as represented by the VNQ ETF, has experienced a notable decline, with a weekly change of -3.7% and a monthly change of -6.47%. The RSI reading of 24 suggests that the sector is in an oversold condition, which can imply a potential reversal or consolidation in the near term. This momentum indicator suggests that the selling pressure may be exhausting, and a bounce or a period of consolidation could be imminent. The trend direction remains downward, however, and conviction among sellers appears strong, as evidenced by the continued downward pressure. Key support and resistance levels will be crucial in determining the next move, with the current level likely to attract buyers looking to capitalize on the oversold condition. The question remains whether the current move is a sustainable breakout to the downside or an extended overreach that will eventually give way to a rebound. A specific technical setup worth watching this week is the potential for a relief rally, which could be followed by a retest of recent lows, leading to a possible consolidation phase. Now let us look at the fundamental catalysts driving this sector. This week, the real estate sector, comprising REITs, commercial real estate, and homebuilders, is likely to be influenced by several macroeconomic factors. The upcoming PCE inflation data and non-farm payrolls will be closely watched, as they may impact interest rates and, in turn, affect the sector's performance. Key stocks such as PLD, AMT, EQIX, SPG, and PSA are signaling a mixed outlook for the sector, reflecting the current elevated uncertainty in the market, with the VIX at 26.8. Earnings reports from some of these companies may provide further insight into the sector's health, while regulatory news could also impact the sector's trajectory. The longer-term fundamental thesis for being positioned in this space remains intact, driven by the ongoing demand for data centers, warehouses, and other types of commercial real estate. Despite the short-term volatility, the sector's underlying drivers, such as the growth of e-commerce and cloud computing, continue to support its long-term growth prospects. As we navigate this week, it is essential to consider the potential impact of economic data on the sector, as well as the performance of key stocks. Given the current market regime, investors should be prepared for potential fluctuations in the sector. Next, let us talk about the specific risks you need to manage this week. The real estate sector is navigating a complex landscape, with several key risks on the horizon, including rising interest rates, which could impact property values, and a potential slowdown in economic growth, affecting demand for commercial and residential properties. Additionally, regulatory changes and geopolitical tensions could also pose significant headwinds. Given the current volatility environment, with the VIX at 26.8, investors should be mindful of position sizing, taking a more cautious approach to mitigate potential losses. Unexpected events, such as a surprise change in monetary policy or a major geopolitical shock, could further exacerbate market volatility. To manage downside exposure, a disciplined framework is essential, including diversification, regular portfolio rebalancing, and a focus on high-quality assets. By adopting a proactive risk management strategy, investors can better navigate the challenges facing the real estate sector. And now for the strategic outlook. Where does real estate stand heading into next week? We maintain a cautious stance on real estate this week, given rising interest rates, which may impact property demand, with mortgage applications down 8%. A key theme to track is the potential for a shift towards more affordable housing. Please note, this is educational content and not financial advice. For more insights, like, subscribe to Financial Market Oracle, and comment your real estate watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.